Every country likes to pretend there is only one price for its money, the official exchange rate, the number printed on the central bank's website, the one politicians quote on television with a straight face while flags wave gently in the background. But in many places, if someone lands at the airport, walks past the bright currency kiosks, ignores the smiling teller behind the glass, and steps out into the city at night, a different price appears. A quieter one, the rate whispered by taxi drivers, the one scribbled in pencil on a scrap of paper in the back of a shop. The number that actually works. In Argentina, that rate is known as the blue dollar. In Venezuela, it became the only number that mattered long before anyone admitted the old one was dead. In Zimbabwe, Lebanon, Nigeria, and a long list of other countries, the same pattern repeats. By day, the government insists that $1 equals this many units of local currency. By night, the street answers, no, it doesn't. That private answer, traded in the shadows, is the real exchange rate. The larger the gap between those two numbers, the more clearly something uncomfortable comes into focus. The official price is about propaganda. The black market price is about truth. Publicly, exchange rates are presented as technical matters, the domain of economists and traders in glass towers, just numbers changing on a screen. In reality, an exchange rate is a public vote of confidence. A currency is a story a country tells about itself, and the price of that currency against others is how much the world believes that story. Governments understand this instinctively. When the story starts falling apart, they rarely admit it. Instead, they fix the rate. They tighten controls. They punish anyone who trades outside the lines. And that is exactly when another market appears. A second exchange rate in the shadows, born the moment the official one stops being believable. When the price of money becomes a lie, black markets become the only place where people can still buy the truth. This is not new. Whenever rulers have tried to control prices from above, reality has pushed back from below. Set the official price of bread too low and shelves go empty. A second price appears quietly in the back room. Set the official price of foreign currency too low, and the same thing happens. The front counter is empty. The real business moves to the back. Historically, governments reach for fixed exchange rates in moments of weakness. During war, after revolutions, in the middle of debt crises, leaders love to announce heroic numbers. They peg their currency to the dollar or to gold or to some fantasy of stability and call it strength. On paper, everything looks firm and dignified. On the street, everything breaks. Importers cannot get the dollars they need at the official rate. Savers do not believe the promise that their money is safe. Tourists discover that if they go to a bank, they receive half as much as someone in the hotel lobby is willing to offer them in cash. The gap between those two numbers is where the illusion ends and reality begins. During the Cold War, this reality ran underneath the surface of entire economies. Communist governments insisted that their currencies were strong, stable, equal to the West. Official rates were often flattering to the point of absurdity. On paper, the Soviet ruble or the East German mark stood shoulder to shoulder with dollars and francs. In people's pockets, something very different was happening. Foreign visitors arrived with hard currency, and suddenly everyone became an unofficial banker. Taxi drivers, hotel clerks, even police officers quietly offered better rates if the exchange happened off the books. Citizens traded jewelry, rare goods, and favors for a few dollars because they understood one thing that never appeared in the speeches. The black market rate was the people's verdict on the regime. If the official rate claimed that $1 equaled 1 unit of local currency, but the street quietly swapped $1 for 5, 10, or 20, that gap was not just economic, it was political. It measured the distance between the story on the posters and the reality in the grocery line. In many of these countries, possession of foreign money was illegal. People went to prison not for plotting revolutions, but for holding the wrong kind of cash. Yet the market continued. It moved to stairwells, kitchens, train stations, whispers shared on long walks home. When official reality and lived reality diverge, people cling to whatever still feels real, even if they have to find it in the shadows. Move forward to more recent decades, and the pattern not only survives, it speeds up. In Argentina, inflation has not been a single crisis, but a recurring season. Governments promised stability, rebranded the currency, pegged it, unpegged it, held up charts and guarantees. Each time the official rate tried to hold a line that the economy had already crossed. On paper, the peso might be worth a certain number of dollars. On the street, another number did the talking. That number, the blue dollar rate, worked like a national stress index. When anxiety rose, so did the gap. People checked it before they checked the weather because it told them something far more important about the coming days. In Venezuela, the process reached an extreme. Hyperinflation did not just weaken the currency, it shredded it. At certain points, the black market rate was not just somewhat worse than the official rate, it was thousands of times weaker. The government could declare, with full ceremony, that $1 equaled 10 units of local currency, while everyone knew that on the street that same dollar traded for tens of thousands. At that point, the official rate is not a mistake. It is a joke, told with a straight face. The punchline lands in empty supermarkets and salaries that cannot buy a week's worth of food. Zimbabwe, Lebanon, Turkey at certain moments, Nigeria more recently. The details differ, but the logic does not. When people expect tomorrow's money to be worth less than today's, they rush to get out of it. If the government blocks the front door with capital controls and patriotic lectures, the line forms at the side entrance. The market simply moves out of sight. Underneath all of this is a hard truth. A government can legislate an exchange rate, but it cannot legislate trust. Trust is earned and lost in lived experience, and whether shelves are stocked, and whether savings hold value, and whether salaries can buy what they bought last month. When that trust is gone, the market that matters is no longer the one announced in press conferences. It is the one negotiated quietly at kitchen tables and whispered under dim streetlights. The gap between the official rate and the black market rate has a simple name: the spread. It is more than a technical difference. It is a fear meter. If the official rate is 100 to 1 and the street offers 110, that signals annoyance and skepticism. If the street offers 200, distrust has taken root. If it offers 1,000, panic is in full bloom. Every percentage point of that spread speaks. It tells a story about how deeply people distrust their government. It reflects how quickly they expect inflation to erode their savings, how likely they think capital controls will trap their money where it cannot escape, how fragile they sense the entire structure has become. Official institutions often try to treat this as a nuisance, a side effect, an illegal curiosity, but in reality, the black market rate functions as a daily referendum on the system itself. Banks can close, automated tellers can run dry, official channels can insist that everything is under control. The number in the shadows, updated each night, reveals what people actually believe. That is why governments fight it so aggressively. They raid currency exchangers. They arrest street traders and seize wads of cash for the cameras. They shut down websites that publish parallel rates. They label unofficial trading as sabotage or treason or a plot by foreign enemies. But beneath those accusations sits a more basic fear. In an economic system built on confidence, any number the government does not control becomes a threat. If citizens trust the night rate more than the central bank, power has already begun to slip. The government has not only lost control of its currency, it has lost control of its story. Inside this shadow economy, the lines between villain and victim blur. It is easy to condemn black markets as dens of criminals and smugglers, and those exist. Yet, in most cases, the people using the parallel rate are not crime bosses. They are shopkeepers who cannot restock shelves unless they buy dollars after dark. They are nurses and teachers, quietly saving a little foreign currency under the mattress, because their local bank has become a rumor factory, not a safe place. They are taxi drivers who offer an off-the-books rate because their official salary, converted at the government's fantasy number, no longer pays for groceries. On paper, these people are breaking the law. In practice, they are stepping outside a fiction that they can no longer afford to live inside. At the same time, black markets create new aristocracies. Those with the right contacts, import licenses, access to official dollar auctions positions near the central bank, can buy foreign currency cheaply at the artificial official rate, and sell it at the expensive street rate, pocketing the difference with almost no risk. The spread becomes a machine that prints inequality. Those who sit near the official faucet arbitrage reality. Those far from power must queue after dark and hope not to be noticed. In this way, the black market exchange rate becomes more than a price. It becomes a map. It shows who has options and who does not. It marks out the distance between the inner circle that benefits from the system and the outer circle that survives in its shadow. In previous eras, this nighttime economy lived almost entirely in physical spaces, alleys, apartments, hotel lobbies. Today, it has gone digital, but the logic is the same. When governments try to freeze or manipulate the exchange rate now, people do not only meet in back rooms. They open encrypted chats. They use peer-to-peer platforms. They send value as digital tokens, stablecoins, or informal transfers through friends abroad. In some countries, the real exchange rate is discovered not on a street corner, but in a messaging app. Thousands of tiny traders scattered across a city or a diaspora quote prices to one another, update them minute by minute, and settle deals without ever meeting face to face. Governments respond the way they always have, by banning apps, blocking platforms, arresting a few visible intermediaries, and declaring victory. Yet as long as there is a gap between the official story and lived reality, the market shifts shape and continues. Technology changes the costume, not the script. Whether the negotiation happens under a flickering streetlight or inside a private chat window, the purpose is identical: to find a price for money that people actually believe. Step back, and the deeper message of the night rate becomes clear. When official stories fail, certain things do not disappear. They rise to the surface. Real assets keep their weight in the world, whether governments like it or not. Land, fuel, food, tools, medicines, usable skills. These survive when clever financial products and patriotic slogans lose their shine. In between all of these, like a nervous heartbeat, moves the black market exchange rate, translating fear and hope back into numbers. Look closely at that number, and several layers appear at once. It reveals trust levels, how willing people are to hold their own currency when given an alternative. It reveals stress, how desperate they are to escape into something steadier. It reveals power structures, how profitable it has become to stand at the intersection between official and unofficial channels. It reveals expectations, how quickly people think things will deteriorate, or whether the worst has already arrived. The signal does not require a degree to interpret. It is enough to place the government or MS declared rate next to the one that people risk fines, arrest, or social stigma to use at night. Where the two numbers nearly match, the system may be flawed, but it is still honest enough to function. Where they drift far apart, the system is already broken, even if no one has announced it at a podium yet. In the daytime, money wears a uniform. It sits behind counters, under logos, on glossy websites. Numbers appear in official fonts, backed by seals and signatures. The story is that everything is under control. At night, that story is tested. Money stops being mainly a symbol of national pride and reveals what it has always been underneath, a claim on real things in the real world, honored only as long as other people agree to honor it. Black markets do not appear because populations suddenly acquire a taste for illegality. They appear because the rules stop matching reality, and people choose reality. The real exchange rate at night is not an exotic curiosity reserved for failing states. It is a reminder written in numbers. The value of money depends on trust, and trust can move faster than any law. A government can forbid a trade, shut down a website, raid an office, even throw traitors in prison. But if enough people believe the official price is a lie, the real business will simply flow around the obstacles. Ignoring that flow never ends well. History is littered with leaders who defended fantasy numbers until the last moment, insisting that their currency was strong while citizens lined up to dump it at any price. The spread widened, the shadows grew, and then one day the fiction collapsed under its own weight. There is always a moment in these stories when the official exchange rate becomes less a measure of value and more a relic on a wall, like an old map of borders that no longer exist. The economy has already moved on. The real trade happens elsewhere, at a number decided not by decree but by desperation and negotiation. For anyone trying to read the health of a currency, a banking system, or even a regime, the lesson is simple. Do not listen only to the speeches delivered in bright rooms. Pay attention to what happens quietly after the shops close. Listen to the numbers that move through the city when the lights are low and the cameras are gone. That is where the confidence, or the lack of it, speaks honestly. When the spread is small, money is still mostly a daylight creature. When the spread grows and the night rate begins to rule, something deeper has already broken. Collapse is not announced in advance. It is hinted at in whispers, and one of the clearest whispers is the price of money at night. If this perspective offers a new way to understand the world behind the statistics, hold on to it. Official numbers will always exist, but the truth about a currency, a system, or a promise often appears first in the places where people trade quietly at their own risk for a price they actually believe. In the end, markets do not care what is declared. They care what people do. And nothing reveals that more clearly than the black market exchange rate, quietly telling the real story while the official one plays on television.